This program was produced by and first broadcast on Radio Kidnappers, a community access media station. Thanks to New Zealand On Air for making this type of programming possible.
The information provided or any opinions expressed in this show are of a general nature only and should not be construed or relied on as a recommendation to invest in a financial product or class of financial products. You should seek financial advice specific to your circumstances from an authorised financial advisor before making any financial decisions. A disclosure statement can be obtained free of charge by calling 0800 878 961. You're tuned to Radio Kidnappers, the voice of Hawke's Bay. This is a program called Canny View. It's our pleasure, as always, to have in the studio Geoff Wilson, from hosts of Canny View, and a member, an associate of the Stewart Group right here in Hastings. How you going, Geoff?
Very well, thanks. Glad to be here.
Just remind our listeners before we get to today's topic, which is your speciality, Kiwi Saver. Stewart Group, what are you all about?
Oh, well, Stewart Group is a family-owned Hawke's Bay-based business, wealth and financial services. And so, yeah, we've been established about 30 years and look forward to the next 30 years.
Now, your speciality is a Kiwi Saver, but you're not just about Kiwi Saver, are you, at Stewart Group?
No, absolutely not. No. So we have specialists in all facets of wealth management, risk insurance, which is life insurance, trauma, and the like, and pensions. Yeah. Now, just in case anyone has been living in a box in New Zealand for the last few years, just to remind our listeners what Kiwi Saver actually is, as if we don't know what it is. But tell us, what is Kiwi Saver all about? So, yeah, KiwiSaver, I think, is about 12 years old now, and it was established by the government back in 2007 to be ostensibly a retirement savings vehicle. But for the younger generation, it's also a savings plan to enable them to get into a first home.
Is it the best thing since sliced bread, financially speaking, for younger people?
Oh, look, I think it's definitely a good opportunity for people to try and get together the deposits now. I mean, we've just read about Hastings being, I think, the fastest growing region in the country with property values. So it's a big ask to just rely purely on KiwiSaver to achieve those deposits. But if children start early enough, then by the time they're 18 or early 20s, they could have at least accrued a reasonable amount of money.
Tell us about the contributions that we might make to KiwiSaver.
Okay, so it largely benefits those that are in some form of employment. So if, for example, like myself, I'm an employee of Stewart Group, then I can contribute directly from my salary. And there are various levels of employee contribution that you can make, so anything ranging from 3% up to 10%. The employer is required to provide a contribution as well, not quite to those levels. Normally it's 3% less a small form of tax. But that also doesn't preclude you from making additional voluntary contributions. So any money that you may have from other sources, you can put in at any given stage. And of course, if you're self-employed, then you wouldn't have the employer contribution component. You would be relying on your own contributions. Then on top of that, you've got this wonderful gift on an annual basis from the government, known as a government contribution, of up to $521.43. It does require you to have put in double that amount, at least double that amount, but in return the government will just drop that tax-free.
You mentioned that you can put any amount into the KiwiSaver fund, so you can really use it a bit like a bank.
Well, the thing about KiwiSaver is that because it's essentially a retirement vehicle, for the majority of people, the only time you can access the money that you're putting in is when you reach retirement age, which is currently 65. So if you're somebody in your 40s and you're putting money into KiwiSaver, you've got to be mindful that that is money that you're not going to be able to access for another 25 years. So you've got to think about that in terms of how much you contribute. However, if you are nearing age 65, or indeed now over 65, because from the 1st of July, the government now allow people over 65 to join KiwiSaver, then yes, you can literally use KiwiSaver as a form of bank, because you can access your money, you can withdraw, make a partial withdrawal or a full withdrawal. You have flexibility there. And more importantly, in the current climate where the official cash rate is so low and the returns from the banks are low, if you have money in term deposits, you're not really earning very much on the investment. And KiwiSaver generally gives you better returns. So you not only have the opportunity to put term deposit money into KiwiSaver, but you also have what we call the liquidity, the ability to freely access that money. But that's only if you're on or near 65.
When I started in this job, KiwiSaver was relatively new, just probably a year or so into it. And I made the mistake, and I do call it a mistake now, of agreeing with the guy who said that, how do you want to set up your KiwiSaver? Do you just want to be in the default scheme? And I made the mistake of saying, yeah, no worries. And then I never thought about it for years and years until I met you guys.
Yes.
Tell us a bit about why that might not be a good idea to be in the default scheme, and what other schemes are available.
Sure. So, in the drive to get people into KiwiSaver, the government established what they call default arrangements with a number of KiwiSaver providers, 9, I think, from memory. And so most people have signed up to KiwiSaver through their employers, and often if they weren't sure what fund they would go in, then in the absence of that decision, they would go into what's called a default fund. Now, the government set out that the default schemes should be of a conservative nature. Therefore, they're relatively low risk, but the counterbalance to that is that the returns that they give are fairly low. They're generally invested in income assets rather than growth assets. Now, 12 years on, you're not alone, I have to say, Kim, because I think at the last count, there's about 15% of KiwiSaver members still in default schemes. That's about 450,000 people. And look, we can't just blame the banks, but the banks are a number of these providers who have perhaps not been quite so proactive as some in encouraging those people to really think about their fund choices. And the theme of this sort of topic today for me was how do we help KiwiSaver members grow their KiwiSaver? And one of those opportunities is to review the investment fund that you have. We do need to take into account people's objectives and situation and age and so forth. In terms of the options, there are conservative funds, which are the low risk but slightly lower return. Then there's growth or even aggressive funds, generally for younger people who have a longer time to invest, and they're more heavily invested in equities or stocks and shares. Higher risk but higher potential returns, and then you've got what we call the balanced, which is sort of the midway point.
Could you conceivably lose money in KiwiSaver?
It is possible to lose money in KiwiSaver. Something pretty dramatic would have to happen with the markets. I think the key thing is, because the markets are moving all the time, that if people know that they are looking to access their money within, say, quite a short to medium term time frame, that they should seriously look at their investment fund. So we take the view that the closer you are to wanting to take money out, that is the time where we look to just ensure that the investment fund is appropriate, that it is perhaps slightly more conservative in nature. So those situations would typically be for younger ones, if they're looking to purchase a first home or put a deposit down, then obviously they want some certainty that the funds that they're looking to deposit are there. So in that situation, the earlier we know that, the better. We would encourage those members to go into slightly more conservative fund. And also in the case of, say, retirement, there are other reasons or other ways you can access your KiwiSaver funds. That's generally through hardship or serious illness. But that apart, those are the situations where we would tailor the fund accordingly. And that's the benefit of having an advisor.
Sure. And when we come to the Stewart Group for advice on KiwiSaver, it's free, isn't it?
Absolutely, yes. It's something that we take great pride in. We established a set of KiwiSaver funds called the asset class funds. We have a particular investment philosophy around that. The underlying provider is a New Zealand-based company called Booster. Pleased to say that we have now at Stewart Group over 1,100 members, but also those funds are accessed by over 200 advisors, financial advice firms around the country that share a similar philosophy.
Can we be hands-on with the investment? I mean, like in the share market, we can say buy that share, sell that share, or we want to be involved with this share over here. Or do we just say we're going to sign up to the ultra-conservative or the growth one, and we don't have any say? Is that what happens?
Pretty much. I mean, certainly with the asset class funds, what we're looking at doing is actually avoiding trying to stock pick or play the market. We have a particular philosophy which is based on decades of evidence that the market does what the market does. And it's a fool's game to try and pick the market. You might be able to pick it 1 out of every 8 times. And we don't think those odds are great, so we allow the markets to do what we do, and we look at the evidence and try and extract the value that we see from the markets over the long term.
What about money in the bank? I mean, every time you turn around, the interest rates are dropping. So, but there are still people out there, particularly older people, that are more comfortable, aren't they, with going to, say, the BNZ or the ANZ, because they can walk into that building, they can put the money in, they see it going over in readies, and it comes back to them almost in readies if you still want, I suppose. Money in the bank or money in KiwiSaver?
Well, as I said earlier, I think that in the current climate where the official cash rate is 1% and mooted to drop even further, then that has, obviously that's a benefit for anybody wanting to borrow money, but for anybody who is saving money through the banks, that sort of reduction in official cash rate is passed on in the form of very low returns. Look, I get that there is this sort of feeling that the banks are solid as rocks.
Yeah.
All the KiwiSaver providers are protected, so that your money is protected in that sense. Your market money can still go down because of the markets, as we touched on earlier. But for those people that are nearing retirement age or of retirement age, you can look at, say, being in a bank and getting, if you would take out inflation as well, next to nothing, whereas you have the opportunity to maybe put that money, once it's off its maturity of term deposit, put that money into KiwiSaver. You can generally get, depending on the fund you're in, anything between, say, 3 to 8% return before tax. That just may be the difference between you dipping into your capital or being able to sort of enjoy the benefits of it.
Before we came to air, we were talking about retiring, and I am now of retiring age, but I dread the thought of retiring. and I can probably see myself working for, I don't know, another 5 years at least. And as long as I've got the smarts to carry on, of course. But someone of my age, would you be suggesting perhaps that I maybe withdraw a little bit from the fund that I'm currently in, maybe go to be more conservative, or say, hey, look, hell, go for the doctor, you know?
Well, I think it's really interesting. In my experience, I don't know too many people of retirement age, currently 65, who are looking to retire per se. We kind of have a view that retirement means that you're able to do whatever you want, when you want, and how you want to do it. So that's more of a definition than saying I must stop work at age 65. Yes, we would tend to say that, or see 70 as being the new 65. And interestingly, if you keep your KiwiSaver going through and you're able to keep contributing to your KiwiSaver through to age 70, then that difference between taking your money out at 65 versus 70 can be really significant. It could be up to 40% more at 70 for those extra 5 years. And that's just the benefit of being compounding nature of the returns over that sort of period. To answer your question, look, it really depends on your personal objectives. Statistically, if you reach the age of 65, you've got an 80% chance of living to age 90 if you're male, 94 if you're female. That might be good news for some and maybe a bit depressing for others. But essentially that means that we've all hopefully got another 25 plus years to enjoy the fruits of our labours. And look, there's no reason. It's a fallacy to think that you have to take all your money out at age 65. Take a little bit of it out. Do the holiday, do the things that you want to tick off the bucket list, but not necessarily take it all out.
Are you surprised in this day and age that there are still more than 1 million Kiwis who aren't in KiwiSaver?
I think the more surprising statistic, I mean, yes, it's 2.9 million. And look, KiwiSaver is not necessarily for everybody. There would have to be compelling reasons why you wouldn't want to be in KiwiSaver. Often that's if you're in a major debt situation and it would be better to put your money towards paying off debt. But that apart, I think, it's 2.9 million KiwiSaver members now, which is pretty impressive effort in a short space of time. But what is slightly more concerning is that about 1 million of those 2.9 million don't contribute to their KiwiSaver. And as we touched on earlier, you know, contributions might be through work or voluntary contribution. So there's a lot of people who are missing out on this free government money of $521.43. I think that's something that we try very hard at Stewart Group. We have a small proportion of our client base that don't contribute, and there can be reasons why. They may be overseas, they may not be in employment, and so forth. So I don't think you'll ever get 100% conversion rate. But the more, the earlier you can start, the less you actually have to put in to, otherwise you're playing catch up later down the track.
Just about out of time. You want to have a quick word about the Australian Super?
Yeah, so we've touched on sort of 4 areas that you can grow your KiwiSaver: your contributions, the choice of investment fund, extending the retirement age when you take KiwiSaver out, bank term deposits for those of nearing or at retirement age. The other one is that there's an awful lot of Kiwis that have spent time living and working abroad, namely in Australia. And the Australian Tax Office have recorded that there's about 17.5 billion Australian dollars in lost or unclaimed
Wow.
superannuation. It's not all Kiwis,
No.
but Kiwis will have a proportion thereof. And so what we provide at Stewart Group for a very nominal cost is the ability to repatriate the Australian superannuation monies and put them into the KiwiSaver investment. Not only does that save people on the fees, they're often still paying fees on the superannuation. Quite often there's an insurance policy that they're paying fees on that actually probably won't even operate because they're out of the country. But more importantly, that injection of monies from Australia can just help supercharge the KiwiSaver. There can be some tax implications, I have to stress that. So we're not tax specialists, so people would need to get some specialist tax advice if they so chose. But that's a service that we're very happy to arrange on behalf of customers.
Is that a two-way street? If I had a substantial KiwiSaver account here, for instance, and I decided I was going to emigrate to Australia for some time, could I transfer my KiwiSaver to my Australian super fund?
Yes, indeed, you can. It doesn't happen very often, to be fair. We see a lot of Australians come over, and there is a bit of a myth that if you come over from Australia and have your pension transferred, that you cannot go back to Australia. Let me allay the fears there. You can. You are required to sign a document that says that you've permanently emigrated, but we've seen people go back once or a couple of other times and then subsequently come back again and repatriated their pension again. But it does work both ways.
What happens if you're going on your OE? I don't know, so here I am, an older man perhaps, and the government is still giving me the money if they were, and I decide to take a year off. Can I put my KiwiSaver on hold, and then when I come back it starts up just like it was before I left?
Yes, I mean, you can still keep contributing to your KiwiSaver if you wanted from overseas, but you wouldn't be eligible for the government contributions for the period that you were out of the country.
Good on you, Geoff. It's been our pleasure to talk with you about KiwiSaver. Now, if we need any advice, any financial advice or insurance advice, KiwiSaver from the Stewart Group, where do we find you? Okay, so there's a couple of ways. You can give us a call, 0800 878 961. Email us, kiwisaver@stewartgroup.co.nz. Or the old-fashioned way, come in and see us. We'd love to see you, 204 Kanamu Road, Hastings. The information provided or any opinions expressed in this show are of a general nature only and should not be construed or relied on as a recommendation to invest in a financial product or class of financial products. You should seek financial advice specific to your circumstances from an authorized financial advisor before making any financial decisions. A disclosure statement can be obtained free of charge by calling 0800 878 961. This program was produced by and first broadcast on Radio Kidnappers, a community access media station. Thanks to New Zealand On Air for making this type of programming possible.